Thank you, Nisha. Hi, everyone, and I'm deeply honored to be here having this conversation with you. And again, I say conversation because I want to make this interactive and make sure that you are getting the most out of this. Let me quickly start by introducing myself. My name is Sannya Joseph, and I head the client engagement team in APAC. And in my role, I tend to work with a lot of clients to understand the sustainability requirements and also to kind of like help meet that gap using S&P data and solutions. Can I actually, before I move forward, Nisha, can I check with you if you can hear me okay and see my screen okay?
Audio is fine. We can't see your slide.
Okay, one second. Let me just try sharing again. Okay, how about now? Let me just. Okay, how about now? Can you see my screen?
Yeah, perfect. Thank you.
Okay. All right, let me see if I can move these panels. Well, we'll just have to ignore these panels. Right, so again, as I said, what I want to do for the next 45 minutes is take you through the behind the scenes or peek behind the curtains of ESG investing. We want to kind of like demystify some of these words and jargons that we hear. We also want to see how does a portfolio manager look at companies and decide if this is something that if this is a company that he wants to include. And I also want to talk about disclosures because it's a very hot topic these days in the market. And I want to end by looking at examples of how ESG risks are being kind of like taken into account when we are looking at investments. And this also kind of like touches into that question that we got, whether in addition to climate change, are there other hot topics that investors are focusing on? So we'll be delving into all of that in the next 45 minutes. Now, irrespective of the kind of ESG fund we are talking about, and there are quite a few type of funds. You have impact investing, you have ESG investing, you have 2-degree portfolios. And irrespective of the kind of ESG fund we are talking about, the approaches that is generally taken to create these funds can be broadly categorized into these 4 buckets, right? So starting from the left to right, and again, this is also in the order of complexity. The first technique is about screening. So here a portfolio manager will set some sort of like a mandate and he will screen out either the bottom or the worst companies, or he will screen in the best in class companies. So let's say, for example, the mandate is to have companies that are ESG friendly. You want to create an ESG version of an index. And let's take S&P 500 as an example, right? So we start with the basic S&P 500 index, and from here we want to keep only those companies that we feel are ESG friendly. So what we end up doing here is we tend to, obviously, starters, remove all the sin stocks, which are basically stocks that fall into alcohol, gambling, or gaming, or weapons, etc. And then we kind of like remove the bottom 20 percentile of the companies which are low scoring on the ESG score side of things. That's your negative screening, where you remove companies which are not meeting your mandate. You also have positive screening, where you can choose to invest in the top 50 percentile or the top 60% of the universe based on that mandate, right? So that's your screening. The second technique is about weight management. Now here, you're not removing any companies from your investment. You're keeping all the companies, but you're adjusting the weight of the stocks in your portfolio. So let's take again the Dow Jones Sustainability Index, the DJSI Carbon Efficient Index. Now the idea here is to create an index which will represent the carbon intensity of the constituents. What that means is you will keep all the constituents, but the weight is going to be dependent on how carbon intensive a company is and what kind of disclosures the company has. So the weight is going to be directly proportional to the amount of disclosures and inversely proportional to the carbon intensity of a company. So here you are doing weight management. You're not screening out anything. Thirdly, you have the carbon attribution technique, and here you're comparing a particular portfolio to the benchmark, and the idea here is to outperform the benchmark by either over investing in low emitting sectors or under investing in high emitting sectors and choosing cleaner or less carbon intensive companies as compared to the benchmark. Again, we will see an example of carbon attribution in the later slides when we explore or examine the SET 100 index. The fourth and the slightly complicated technique of ESG integration is called as mean variance optimization. So here the manager doesn't choose stocks as such. What he does is he sets out criteria. So for example, he says, I want to create a portfolio which will have, let's say, a 2% tracking error. And he will specify the minimum and the maximum weight a sector can have in the portfolio. And he'll also specify some sustainability related mandates saying, let's say the carbon footprint of my portfolio should be less than 20% of the benchmark. So he specifies these criteria or constraints, and then the optimizer that churns out various permutation and combinations and comes up with that list of stocks and the weight of these stocks that is going to meet your criteria, right? So that's called as your quantitative approach. Now, let's say, for example, I was an ESG fund manager, right? Now, before I even start applying any of these analysis, the first thing that I would like to do is I want to understand the current landscape, or I want to understand the current index. So let's say, for example, I start out with SET 100 and I want to understand where is SET 100 currently with regards to sustainability and ESG metrics, right? So first I apply the ESG scores analysis on it to see what is the ESG score of the SET 100. And obviously the score ranges from 1 to 100. And the closer you are to 100 means the more ESG friendly you are. So the ESG score for SET 100 is close to 70. And even the environmental, social, and governance scores are there in the top 1/3 percentile. If I look closely at material factors in the environmental side, and here please note that a green score indicates that it's a better performer with regards to that criteria. And if it is an orange, means it is a area of improvement. So when I look at environmental factors like operational eco-efficiency, climate strategy, environmental reporting, and water-related risks, these are all very important environmental factors. And SET 100 seems to be generally green or doing well on these factors. Likewise, from a social score, important factors like occupational health and safety, talent attraction and retention, human rights, and corporate citizenship and philanthropy. Again, very important factors where SET 100 companies are generally doing well. But when I come to governance, and the factor which is the highest weighted factor in the governance section, which is corporate governance, this is clearly an area for improvement for the SET 100 firms. Now, this was from the ESG perspective. Let's deep dive into the whole environmental side of things and compare the carbon footprint of SET 100 with, let's say, the MSCI World Index, right? So over here is the carbon footprint of the SET 100 index, and this is the carbon footprint of the MSCI World Index. Now, obviously, as you can see, the carbon footprint of SET 100 is a lot higher than that of the MSCI World, and most of its carbon footprint or emissions is driven by its scope 1 or direct operations. Now, this is both good and bad news. Because good, because it means that the companies themselves have a lot of control over these emissions, and bad in a way because it just means that we need more active stakeholder engagement. And as an investor, I need to work more closely with my investee companies to identify the decarbonization paths or the decarbonization changes or policies that the company is thinking about. And if the company is not thinking, then I need to kind of like have that conversation about how do we kind of like mitigate that risk, right? Now, again, as I said, we're going to apply the whole carbon attribution section to the SET 100, the carbon attribution technique to the SET 100. I want to focus on this column called as the sector allocation. A positive number here means that we have underweighted high emitting sector, and a red or a negative number indicates that we have overweighted a high emitting sector. So if I look at something like materials and energy, I see a big negative number indicating that the SET 100 has a higher allocation to these industries as compared to the MSCI World benchmark. As well as when I look at the company selection, a negative number here indicates that I have invested in more carbon intensive companies in these sectors. So if I look at materials has a very strong negative number here and also a very strong negative number here, indicating that A, I have overweighted the material sector in my index as compared to the benchmark, and B, I seem to have invested in more carbon intensive companies as compared to my benchmark. But if I look at energy, the sector allocation is negative, indicating a higher allocation to energy sector, but my company selection is positive, indicating that the companies I've selected in the energy sector are less carbon intensive as compared to the benchmark. Right, so this gives me an idea of where and what I need to reduce. The next thing I want to do is look at the companies themselves and see who are the top emitters and what kind of 2-degree alignment do these top emitters have. Now, it is not surprising that the top 10 companies generally fall into the into the materials and in the energy sectors. And over here is the list of those 10 companies, and apologies if it's not very clear. And over here on the right-hand side, we have looked at the decarbonization requirements for these companies. Now, a little bit of a background or some sort of like a note on this whole 2-degree alignment. Now, the way a company thinks of decarbonization is going to be different depending on what sector it is and what sort of a market share it has captured. So for some sectors like power generation, it's going to be easier for them to decarbonize because you have proven alternative green solutions like wind power generation or solar power generation. However, for some sectors like cement, because of a lack of proven green alternatives, the decarbonization pathway is not going to be very clear. Likewise, not all companies in the same sector will face the same decarbonization burden. A bigger dominant market player will have a bigger onus to decarbonize faster as compared to a smaller player. Now, it is not very surprising that if I look at the companies in the set 100, which has the highest carbon deficiency budget, which means that they need to decarbonize more, it is not surprising that the companies here and here overlap. The biggest companies, the most carbon intensive companies would have a stronger onus to decarbonize and would need to have a stronger pathway to reduce their emissions, right? So this is my analysis as a portfolio manager. Now, in an ideal world, all of this analysis would be based on 100% disclosures from the company. My carbon footprint would be calculated using the carbon information that the company has disclosed. My 2-degree alignment would be based on the targets that the company has set. And again, here I'm assuming that all the companies would have set targets or even science-based targets. And my ESG analysis would have also kind of like been driven by the information that the companies have given, right? That is an ideal world. Unfortunately, we don't live in an ideal world. So what that means is that the current disclosures that we currently have is far less desirable, or it's far from where we would ideally want to be. So this graph over here, it looks at the various indices and various developed and developing markets, and the bars represent the amount of disclosure and the black dots represent the carbon intensity of these markets. Now, when I look at a market like Dow Jones Sustainability World Index, obviously it will have a very low carbon intensity, and they all have very high disclosures, almost reaching 100%, right? Likewise, if I look at S&P Global 1200, which is your biggest countries or the biggest companies, biggest 1200 companies, again, more than 80% disclosures, right? What do I see when I come to the S&P BMI emerging markets? The minute we come to the emerging markets, we see two things. One of the highest carbon intensity across the different markets. And secondly, one of the lowest disclosure rates. This is the challenge that we face. Some of the most carbon intensive companies and markets have the lowest disclosures. Energy sector has the third highest carbon intensity and less than half of the companies actually disclose their greenhouse gas emissions, right? So when it comes to disclosure and when it comes to financial disclosures, it's relatively easy because we already know what metrics we need to disclose. You already have accounting standards. It tells you exactly this is how you have to calculate your book value, this is how you calculate your depreciations, and this is how you report on your 10Ks and 10Qs. Financial disclosures are relatively easy, but when it comes to sustainability related metrics, the disclosure becomes a little bit more difficult because you can think of it as a little bit more vague and intangible, which is why one of the challenges that the companies, and we totally recognize that one of the challenges that companies face with regards to ESG disclosure is what to disclose, right? And here too, as Olivier had mentioned in his previous slides, we do have a couple of frameworks. You have the GRI and you have the SASB. Again, GRI is a global reporting initiative. It's a little bit more broad and has come up with factors that are applicable across different industries. SASB is a little bit more nuanced, and it basically looks at industry-specific evidence-based factors where it has identified specific factors for specific industries. So on the left-hand side, sorry, on the right-hand side, I'm comparing some of the material SASB factors for healthcare and beverages. So as you can see from here, and apologies if you can't see my screenshot well, air quality and waste and water management are material factors for healthcare industries. However, air quality is not a material factor for beverages, and greenhouse gas emissions, energy management, and waste and water management are material factors for this industry, right? Now, in addition to these existing standards, I do also want to talk about the S&P Global CSA framework, which is very much similar to SASB in the sense that it has come up with a set of factors. It has around 25 or 35 different factors. Some of them are pan-industry. So concepts like human rights, climate strategy, corporate governance. So these factors are going to be equally important and applicable across different industries. And then you will have certain industry-specific factors like, let's say, biodiversity, water-related risks, fleet management, green finance. A lot of these industry-specific factors that are going to be material for different industries. Our definition of materiality is similar to the SASB's definition of materiality, where we are talking about financial impact. If a company were to slip up on any of these factors, what is the probability that it will result in an impact, and what is the magnitude of that impact both on the company as well as on its external stakeholders? Now, let's, for example, look at something like operational eco-efficiency, or even let's say environmental reporting, right? Let's look at environmental reporting. If a company slips up on environmental reporting, there is a 90% probability that it is going to result in financial impact. And the impact on the company is going to be greater than the impact on the external stakeholders. But if you look at corporate citizenship and philanthropy, which basically talks about the donations and volunteering activities that the companies have with the society around them. Now, if a company slips up on corporate citizenship and philanthropy, there is a 60% probability that it will result in an impact, and that impact is going to be greater on the external environment than it is on the company, right? So that is the idea that S&P has in its proprietary CSA framework, which basically is a questionnaire of around 100 questions. So the way we think about CSA is that it's not mandatory. We do not force the companies to kind of like take our questionnaire, right? We reach out to companies and we ask them if they would like to kind of like fill in the CSA questionnaire. Now, a company can choose to say yes, in which case a company will fill in our survey and it will return it back to us along with supporting documents, and we will assess that company on that information that it has provided to us. A company alternatively can choose to say no, in which case the company is going to be assessed based on the publicly available information. Now, this is a comparative analysis of two Thai companies in the oil and gas industry. And we have actually made this anonymous. We call it company A and company B. So company A is a survey respondent and company B is a public assessment. Now the data availability in the public domain is low, indicating that of all the information that we needed to correctly assess that company on material ESG factors, this company actually has very low information in the public domain. Now, if you don't have information in the public domain, it makes it very difficult for us to correctly or accurately assess you. So if we cannot assess a company on a specific criteria, we just end up giving it a 0. So compare the environmental score of company A with the environmental score of company B. The climate strategy, it scores a 90, and it is a very important factor for environmental, right? Now, climate strategy for this company gets a 0 because it has not published any net zero initiatives, any targets. It hasn't talked about what its climate strategy is. Likewise, when it comes to water-related risks. Again, water is a very material component for the oil and gas industry, right? So what kind of water-related risks is the company facing? What has it identified? What has it thought of as mitigation efforts? None of this is available in the public domain, which is why the company gets scored a 0. And this does impact the company's environmental rating. Likewise, if you look at the social concept, the concept of occupational health and safety, when we hear about it, we think of a very vague notion of how do I measure occupational health and safety. But there are metrics that we can use to measure it. How many accidents were caused in a particular year, how many sick leaves or how many working hours was lost because of those health issues. Now, if a company doesn't report on all of those metrics, again, how do we correctly or successfully evaluate a company on occupational health and safety? Same with human rights. A lot of these concepts, even though they seem intangible, but the way S&P CSA thinks about it is that we break it down into subsections. Does a company have a human rights policy? Is it a public policy? Does it have processes in place to identify the breach of a human right? Does it have redressal mechanisms in place, right? A company may have information about some things, but it may not have information in the public domain about all of these things. But I do want to highlight that intuitively there are certain factors which everybody deems important. Corporate governance. So things like your board structure, information on your board's tenure, your gender diversity of your board. So there are some factors which most companies intuitively deem important, and there might be more information available on that particular factor. In fact, corporate governance is the only factor in which company B scores higher than company A, even though this was a public assessment, right? What I'm trying to highlight here is that having a lot of information in the public domain around these factors is extremely important because there are a lot of investors asking for this. So if you don't tell your story, then somebody else will. Taking the ESG CSA assessment is a good one, or the good first step in having that sort of like a sustainability assessment, having that baseline, having that report that can be published to the investors. Right? Now, we have talked about disclosures, right? Now, I want to talk a little bit about how does an investor think about climate risk. Now, this is a screenshot from a TCFD framework PDF, and I'm sure a lot of you have already seen this screenshot. What it basically says is that when we think of climate change, people generally tend to have a very negative connotation. We think of risks associated with climate change. So what kind of transition risk is there, what kind of carbon taxes we may have, what kind of physical risk there's going to be. But there is an equally stronger opportunity associated with climate change. You can become more energy efficient. You can kind of like future-proof yourself. You can capture more of a market share by coming up with, greener alternatives. But be it risks, be it opportunities, there is going to be a tangible impact on your financial statements. you have a physical risk. There was a flood, it impacted your factory, which would impact the revenue that you can generate because of your lost production time. You think of opportunities and you put in place, let's say, R&D to capture, to create more products, or you kind of like put in technology in place to capture green alternatives. That is going to require capex, which is going to sit on your balance sheet. The R&D spend is going to sit on your balance sheet, right? So the financial market at this point have pretty much made peace with the fact that yes, climate change is going to sit on my books. Now, how do I take that number? How do I apply that on the valuation of a company? Let's say, for example, I am a asset manager and I currently am working with this company whose stock price is trading at $1.57, right? I want to price in some sort of like a policy risk. I want to price in the carbon tax. So as Olivier mentioned in his previous slides, as the world moves more cognizantly towards a net zero future, we will have carbon taxes. Now, what kind of carbon tax we will have in the future, nobody knows. So we assume that the world can go through any of these three futures. There is a future with low carbon tax, meaning that the policies in place are not going to change that drastically. It's going to be business as usual, and you will have low carbon taxes in the short to medium term, and maybe even in the long term. The medium carbon tax scenario assumes that things are going to be slow initially, but it's going to start picking up from 2030. There's going to be strong mitigative efforts, and we will have high carbon taxes in the future. The high carbon tax scenario assumes that the world is going to go through strong mitigative efforts right away. We're going to see strong policy actions that the governments are going to take by imposing carbon taxes, by imposing fossil fuel taxes, by having emission trading schemes, right? And in all of these three futures, we calculate what is the carbon tax a company may have to pay. Let's not go into details of how we calculate that carbon tax, but suffice to say, we calculate what the carbon tax the company may have to pay in 2025, 2030, 2040, and 2050, depending on the scenarios that we are projecting the world to go through, right? So a typical equity analyst will pull up all of these financial ratios, and he will need all of those financial ratios for projecting the company's net income and revenue till 2050. I'm sorry I couldn't have a screenshot which screenshotted till 2050, but this whole analysis goes up to 2050. Right, so your typical DCF model starts by projecting a company's revenue and net income. And what we are doing now is we incorporate another line called as the carbon cost. This carbon cost is an expense that the company will have to bear. So you account for that carbon cost in that company's DCF model, and you now calculate the adjusted net income, and from there you calculate the implied equity value. There are a couple of methods in which there are a couple of methods that you can use for calculating these implied equity values, but you would see that in this case, more or less the numbers are 70 cents, 98 cents, and 88 cents. So on an average, let's say 80 cents. What this analysis shows is that a stock price which is currently trading at 1.57 may soon, its actual value may soon drop to 88 cents or 80 cents, right? So you take into account that implied drop in the equity price based on the company's regulatory or policy change risk, right? But it's not just about environment, right? Somebody asked about, in the previous session, somebody asked, what are the other challenges that we face with regards to, in addition to climate change? And I would say social inequality is a very strong topic, right? So when we think about social inequality, what is it that we are thinking about? And let me see if I can move this. Yeah. We are so this is this research work that GIC ThinkSpace had done. GIC is a sovereign wealth fund in Singapore, and it does a lot of this research work on ESG related impacts on financial markets, and it has published this paper. And again, there's this link here. it has published this paper on how social inequality can impact financial markets. The way GIC thinks about social inequality is that it's a composite index that captures three economic inequality: inequitable access to income, inequitable access to wealth, and inequitable access to opportunities. When you look at this composite inequality index, what we find out is that as this inequality increases in the developed markets, the political instability increases, but not as much as it does in emerging countries. And as this political instability in the emerging countries increase, it has a very direct bearing on the risk premium associated with the bonds of that country. Right, as we are all aware of, whenever a country issues the bond, depending on the credit rating of that company or the risk associated with that country, there is a country risk premium which is used for discounting the bond price. Now, because of this whole impact of social inequality, the risk premium associated, the country risk premium, becomes higher because of the social inequality. Right, so it is not just about it's not just about climate change, it's also about being holistically more sustainable, right, being more inclusive. And lastly, I want to stop by looking at the actual real life examples of where there were these considerations in where we had these ESG considerations by investors. Let's start by looking at the chart on the right hand side. When you look at the investor activist campaigns globally in the last 10-15 years, you would notice that the themes that have now very strongly emerged is human capital and climate change. Again, it's not just climate change, there is an equally strong focus on human capital and workforce. Also, if you take this example of Unilever, and this was a very talked about deal, Unilever was trying to spin off its tea plantation business in Africa, and it had gotten bids from buyout groups like Advent, Carlyle, as well as tea business. Forgetting who the third one was. Yeah, I'm forgetting who the third one was, but basically Advent and Carlyle actually pulled out because of human rights concerns regarding the worker conditions in the plantations in Africa. Right. So this was very much touted about because this deal did not just focus on profits. It basically looked at how private equity groups approach worker pay conditions as well as safety, in addition to climate change. Likewise, when the Saudi-led consortium wanted to take over Newcastle, the deal completed, but there was a long delay because there were kind of like issues with piracy as well as human rights concerns, right? So the point I'm trying to make here is that we are out of that world where people thought of ESG risk as a very vague, intangible idea. And we are in a world where investors are continuously thinking of more and more ways of incorporating this in their decision making. Data is very important for decision making. We need to make sure that our data is out there in the world. We need to be more transparent and we need to disclose a lot more than what we were previously. I believe that the ESG disclosure has now become equally important as financial disclosures. Right. So on this note, I'm going to just pause and I want to see if there's any questions, any comments that I can take from the group or the audience.
Yeah, thank you for sharing, Sannya. So yeah, there is look like quite a number of questions on the chat box. So perhaps I can pick for those questions that related to your content. One interesting question here is asking about, I think everyone might curious how we put the assumption on carbon pricing.
Okay, good. I'll start with that. So S&P, the way we talk about carbon prices is it's based off the work done by OECD. So this OECD kind of like looks at the projected carbon prices in different parts of the world. So we take this information from the OECD 2020 reports. And the way OECD looks at carbon price is not based on just carbon taxes. It also looks at any fossil fuel subsidy that is in place. It looks at any EU, it looks at any emission trading schemes that's in effect in a specific country, as well as any sectoral discounts that may apply, right? So basically, we're taking this work from the work done by OECD.
Thanks, Sannya. I believe we have another 10 more minutes. So if you don't mind, I will go to the next question. So how S&P Global gather 2-degree alignment budget for the company? This is next question.
Right. So the way we think about the budget, and let's take a step back from budget. Well, it's a very important topic, the budget, but the way we think about the decarbonization, I want to expand this to a broader question around decarbonization. Different sectors will have a different decarbonization approach. So when you look at companies in low emitting sectors or companies with heterogeneous businesses, the way we think about decarbonization is that we say that, you know, a company would need to decarbonize every year at a specific rate. And again, you can think of that decarbonization both at an absolute level, where you're saying that the company needs to drop its emissions by, let's say, 7% every year. Or we can look at it from an intensity perspective, where we are saying that for every $1 million of profit, we want the company to reduce its intensity by X%, right? However, when you're operating in certain high intensive sectors, and if you have a homogeneous business, let's say you're in power generation or air transportation or cement or steel production, the way we think about that is different sectors, and this is again based off the work done by IEA, different sectors would have different challenges when it comes to like decarbonization technology available, when it comes to alternatives available, right? So we treat each of these sectors differently, and there is a sector specific intensity that on an average a sector needs to attain by 2050. So there the effort is that if that sector needs to reach a particular level of intensity, what is the role the companies in that sector need to play? If you are a bigger player, if you have a higher market share, then you need to actually be more responsible and reduce your emissions drastically, right? So that's the gist of how we think about decarbonization depending on what sector a company is in.
Yeah, thank you. So for this question, I am not quite sure whether I understand this correctly, but the question is asking, is emerging market data from company participated in DJSI or S&P gather from the company disclosure? So I get is what is the underlying data when we do the assessment?
So when we look at a particular company, sure, company-related disclosures is a very important part of our data gathering process, but we don't just stop there. We also work with other bodies like CDP to see if they have disclosed information to CDP. Again, CDP, for those of you who are not aware, is a not-for-profit organization which actually works with companies for collecting their disclosures, and they kind of like break it down into very granular buckets. Right? So we also collect information from CDP, and we, in a lot of cases, we reach out to companies themselves to see if they can have some sort of like a clarification on any of the disclosure questions that we may have. So we also do company engagements as well.
Thanks, Sannya. And I believe like a lot of people here already familiar with the DJSI questionnaire that you kindly help us with all those questionnaire yearly basis. So this might link to another question. So I believe a lot of people are familiar with the DJSI, but what is the relationship between ESG score, ESG CSA assessment, and true cost?
That is a very interesting question. Okay, let me warm up to answer that question. So, right. So it's a chicken and an egg thing. So the way we think about DJSI is you need to be a top performer with regards to sustainability in order to kind of like be part of the DJSI index, right? So you need to have a CSA assessment, you need to have an ESG scores, and in your sub-industry, you need to be in the top 20. You basically shouldn't be in the bottom 20, 30 percentile, right? So ESG score is important for you to be considered to be a part of DJSI, but having an ESG score doesn't doesn't guarantee you a position in the index. Being a top performer and having the highest or one of the highest scores in your sub-industry group may guarantee you a spot in the DJSI index. Again, there are a lot of other considerations like float and revenues and all of that, which is another consideration as well. That is how ESG scores is related to DJSI. And when it comes to true cost is important because this is where we're collecting all the environmental information associated with that company. What kind of emissions does it have? What kind of Paris alignment does it have? And this information is used by other parts of our business to kind of like create products. For example, your Paris aligned carbon transition indices. Now, this uses the true cost information to now create a new index, right? So you can think of index, which is, it could be your packed indices, it could be your S&P ESG score index, it could be your DJSI index. The index are the consumers of all of this data that we collect, be it the true cost data, be it the ESG scores data. Different indices take different parts of this information to now create a new final product. I hope that helps.
Thank you, Sannya. Yeah, so I have another question that quite interesting as well. So this is more on the private market space. Not very sure whether Olivia would like to address this, but how do you see role of startup and SME in transitioning to the low carbon economy?
Actually, that's a very interesting question. And Olivier, I'm happy to hear your thoughts, and I'm happy. Okay, let me go first, and then please feel free to add anything that you may like. Right. So the way we think about startups is most people think just because I'm small, I don't really need to do anything. Just because I'm small, I don't really need to have an effort to kind of like promote circular economy. I don't need to make an effort in kind of like decarbonizing. I don't need to make an effort in being resource efficient, right? So I do feel a lot of startups playing a very important role in helping us gear towards the whole low carbon economy, right? When you're a giant, it becomes difficult for you to move from coal on to, let's say, carbon capture batteries, right? But when you're a startup, you are more nimble. You can spend more. You can actually have more ideas and more research and more different kind of products that you can come up with. One of the biggest role, in addition to reporting, that I see startups contributing in is in coming up with these low carbon products, right? That's the biggest, in my opinion, that's one of the biggest contribution that SMEs can actually provide. And Olivier, I'm happy to kind of like hear your thoughts on this.
Yeah, no, I fully agree. I just wanted to add that, those scenarios that we mentioned earlier in the IEA scenarios, net zero by 2050, they work. You have, these projections are based on a certain number of assumptions. One of the key assumptions is that, there are a number of innovations in terms of carbon capture, in terms of, carbon efficient technologies that have to be provided, as Sannya mentioned, by small companies, by climate tech, and these technologies some of them do not exist today, right? So they are needed for that scenario to actually materialize. So it's not just a question of, do they have to, but there will be a natural incentive for those companies that will promote those solutions to get access to more funding as well.
Right. I see there's a question about, are we referring to any specific industry? Well, I wasn't referring to a specific industry, but then when we think of fintech, when we think of companies that are doing circular economy, like companies that are doing waste management or recycle, right, or companies that are helping with producing solar panels, there isn't one specific industry for which this is applicable. There are multiple industries where you can play a very significant role in identifying products that can help channel the industry to a greener side of things.
Yeah, thank you, Sannya and Olivia. And I think one more question. This is quite interesting as well, because we've been talking about, for example, our example is oil and gas and all those. And a question here is, what are your suggestions for the company that have low exposure to climate risks? Do it need to perform all the site-based target scenario or any calculation for example, carbon pricing? Yeah, and I'm checking with the participant on what industry you are referring to. Yeah, happy to answer
trying
on.
to be industry agnostic as well. So as I said, the way we think about climate change is so geared towards risk that we like, if I don't face any risk, do I need to do anything? But let's think about it from an opportunity perspective as well. You don't have the risk, but then can you capitalize on the opportunities that you have? Have you identified what kind of greener opportunities that you can actually move towards, right? So I wouldn't say that just because you are a smaller firm who may not have climate risk, but then you may have a great exposure to climate opportunities. Let's try and capture the climate opportunities. Not sure if, Olivier, if you wanted to add anything.
Yeah, and I want just to say, how do you know that you have no exposure to climate risk without doing the assessment? Because, like when I'm looking at the question, I'm saying, okay, carbon pricing, you might be saying, I don't have high emissions, therefore I'm not so much exposed, or in my entire value chain, not so much exposed. So to transition risk, for example, but, are you sure you have assessed all your physical risk vulnerabilities? So even staying within the, I agree with Sannya that risk is not the only approach. Opportunities is another important angle. But even from a pure risk perspective, are you sure that each of your operations, each of your assets, are not exposed to any kind of physical risk exposure? And I guess to know that, first you need to go through that exercise.